Today we are joined by Joerg Hoffmann, Head of Investor Relations at Wacker Chemie AG, to present the company's full year 2025 financial results. As one of Germany's leading specialty chemicals and advanced materials companies, Wacker provides investors with a highly relevant view into global chemical market conditions, pricing dynamics, cost competitiveness, and the strategic outlook for silicones, polymers, biosolutions, and polysilicon. Joerg, we are very pleased to have you with us today. The stage is yours.
Hello, everybody, and welcome to Wacker Chemie. My name is Joerg Hoffmann. I do investor relations at Wacker Chemie, and I'd like to talk to you about our full year results 2025. We published these results on March 11th. There's a conference call replay actually available on our website, but before you jump to that, let me walk you through the slides. Obviously, a notice from our lawyers. Here's an overview of our 2025 numbers. We achieved sales of 5.49 billion euros, slightly below the prior year, with an EBITDA before restructuring of 529 million euros. After restructuring, this was a different number. We had about 100 million euros restructuring, and we had some substantial impairments that we're going to touch later. And I'll explain the rationale behind those. So the reported EBITDA ended up being 427 million euros, significantly down from the prior year. Net income turned out to be minus 800 million, again, accumulation of effects, of which 800 million, 600 million were in net and non-cash charges. Our dividend policy is to pay out 50% of our net income. Well, this was a net loss, so we're not paying anything out of a loss. We've started a substantial program called PACE. This is a restructuring program that goes at the heart of the operations into production fixed costs. There are some really exciting things happening. We're expecting to cut annual costs by about over 300 million euros per year. And we think we can get the first 200 million already in the first year. A message on sustainability, you know, this is important to us. This is important to our customers. And this is why we feature this year prominently. But we achieved an A rating at CDP and with CDP, EcoVadis, a gold rating sort of 28,000 companies. We are in the top league among those participants. I'm pretty proud of that. And it's actually a differentiating factor with customers. It's not always the decisive factor, but it is a clearly differentiating factor that helps narrowing down the field. But let's move on. Go to our next page. So, as I said, the restructuring program is well underway, with focuses on production and administrative costs. About half of the reductions are expected to result from a reduction in personnel. Just to put this into perspective, we're planning to cut about 1,500 jobs worldwide. This is about 10% of the employee population in Germany that is going to be affected by this. So this is not an insignificant program. It's actually rather massive. So what we're looking at is labor productivity, maintenance, engineering. Key thing, if you have these large units that we operate with highly corrosive materials, production-related services, this can be maintenance and other things, and also in procurement. There's still room to work. We still have situations where we have single supplies, so this is something that we're actively targeting and very successfully targeting. Actually, one of the sources for the early gains in this program. So, as you see to the right, we expect about 200 million. The CFO said on the call when questioned about net effects, because obviously these are all gross savings. So net effects minus inflation, he expects to retain about 50% of the savings in 2028. Still, I think that's a rather impressive result. On March 11th, we provided our outlook for the full year for the first time. You will recall that we had preliminary numbers already published at the end of January. So we usually do to give the market some orientation and to open the window for capital markets communications for us. But here's the outlook now for this full year. Makes sense to do this after the audit committees has been through this and after the Chinese New Year, because then you have better visibility. So now we're seeing EBITDA in a range of 550 to 700 million. The midpoint is bang on the consensus. I think the really important piece in all of this is that the CapEx goes down from over 600 million to just 300 million, and it's going to stay below depreciation for some time because our focus is now on filling capacities and not on adding more capacities. As a caveat, while we were doing this, things were going bazoom in the Middle East. And we still await results from trade disputes in the US around the whole solar theme. So since we don't know, we didn't factor that in, and we figure it's much more honest to give you a straightforward view and then mitigate it with whatever comes, then come up with scenarios that we all know never come to fruition. So this is our outlook. I said we're reducing our CapEx significantly to 300 million. That doesn't mean that we stop growing. And that doesn't mean that we're curtailing our options for growth. Actually, we continue to invest to solidify and expand our global leadership positions. So you see this in silicones. We're investing in Zhangjiagang, Tsukuba, and Jinchuan, and in Germany and Nünchritz for specialty assets. And in Karlovy Vary, which is Karlsbad in the Czech Republic, where we are going to produce high-performance silicones. The hall for all of this already, it's pretty huge. Polymers, additional VAE capacities for the US market. This is a market that is very attractive for us. VAE is a market share gaining alternative to other binder systems, and it's gaining a lot of traction in the US. Biosolutions, I think, is something that we covered before. And I think the crown and the jewel in this portfolio of CapEx options is the etching facility for Polysilicon Burghausen that we completed last year on time, on schedule. It was fascinating to see how my colleagues have been working a digital twin to work on all kinds of tweaks and already some efficiency gains before the whole plant went up and the lights were turned off. So pretty impressive. So obviously we're in a situation, as you've seen with our contracting EBITDA in the CFO section of a negative EBIT. Something needs to change. And change doesn't start with assets, change starts with people. So our strategic priorities are with the people that need to make this happen. We have functional structures and processes, but there is more potential in them. We can streamline processes. We can have proper end-to-end processes that can be supported by the right digital tools. Whereas right now we have a myriad of different structures that don't really intermingle. So the growth structure that we're merging into something more exciting. It's already on the way. It's looking very promising. Order to cash cycle and other cycles involved. It's quite a comprehensive program, but it's something where we are certain that this is helping us improve our efficiency, helping us to supply our products better to the customer and service our customers better. We're looking to elevate our business model and value proposition. This whole shift towards specialties, that is something that encompasses the entire organization. Now, this is easier said than done because it involves a mind shift. It involves the shift that you're no longer working towards an industry specification, but that the customer is core and center of everything that you do. And that's behind this triangle. And obviously the whole thing only flies if you have a cooperative, entrepreneurial culture and the right people to execute the job. I think we are very well positioned for all of those. And actually, it's a start to a quite exciting journey. Looking forward to that. So, well, now we're entering the CFO portion of the conference call. As you see here, we start off with the P&L. I think the most important information is actually in the bottom right-hand side, but the bridge. You see that FX played a massive role in headwinds versus prior year. You may have seen that the US dollar appreciated significantly versus the euro after the first quarter. And so that's created a lot of headwinds for us. Volume mix, but also price pressure, largely from imports, mostly out of Asia, were responsible for the reduction in sales. And if you look to the left into the table, you'll see that our EBIT actually was negative at minus 180. Yes, that contains restructuring expenses, but even if you allow for those, it's still negative. And that is the core reason for all these initiatives that you're seeing. So let's move on. If you've seen us before, or if you've heard us before, something that we pride ourselves in is the strength of a balance sheet and the way that we do conservative accounting. You see here a balance sheet with a very high equity, shareholders' equity portion of 45% of the overall balance sheet. Balance sheet actually contracted a bit versus the prior year. So as we had impairments, and we'll go into that in a moment, we are maintaining cash and securities, and our net debt is right now at just about 880 million euros. So still slightly above our EBITDA for this year, but definitely lower than what you see in the rest of the industry. Our target is in the long run to get to a gearing ratio of below 1. Some of you may say that looks like an inefficient balance sheet. We say we've been through cycles, watch this space. So let's move on. Let's start with the silicone segment, which is our largest and actually, I think, most exciting business. So we've had a difficult fourth quarter in that we were significantly reducing our working capital, which created a lot of cash, but also if you have products that have a high fixed cost component, weighs on your P&L. So that tilted somewhat in the fourth quarter. As you can see here, it was 40% down versus the prior year. The biggest effects actually were from working capital reductions. Sales was overall held back by negative volume and mix effects. Specialty pricing, however, stayed resilient, while the standards market sees the full brunt of Chinese imports. Not maligning those, the European market relies on imports from China because we've had so many capacity closures here in Europe, but there's really no connection to the specialties market. So the important thing on this slide actually is that we expect for the full year sales at prior year level. So you see 2,700 million euros with higher volumes on prices somewhat offset by negative FX effects. On the other hand, we expect our EBITDA margin slightly above prior year. This is already the PACE project kicking in, but this is also a further step on the transition towards a more specialties-driven, higher value proposition portfolio. Let's move on. Polymers. Similar issues as in silicones, yet the outlook is also pretty much the same. The Q4 results here were at the same level as in the prior year, largely owed to significant cost reduction efforts that took place there and some portfolio optimization. We saw a pretty strong performance actually in the European region, whereas the weakness in China, you're probably familiar with the construction crisis in China, and this is a largely construction-focused business, held us back. Moving on to Biosolutions. Biosolutions is a small, promising part of our portfolio. It has really exciting technological solutions, but it still lacks scale. So until we see the scale showing, we will not see the full results. The outlook for this year is similar to last year. The market environment stays challenging. We've seen many CDMOs, which is the business model here, restructuring. We expect sales, however, to go up year over year. That's largely driven by the highly successful biopharma business, held back by other parts of the business. But we think we can manage to keep the EBITDA for the full year at about the level of 24, so significantly higher than last year. And there we go to Polysilicon. Well, Polysilicon is a tale of two cities. The semiconductor business, which is going really great, all underwritten by contracts. It's quite amazing. If you look into the semi industry, you have the so-called advanced nodes, which is HBM for AI or below 3 nanometer nodes on wafers. That's where most of our stuff goes. And then you have the legacy design rules, where demand is rather slow, largely because the more capital capacity consuming advanced nodes are taking it away. So we have seen semi polysilicon volume growth in the pretty high double digits last year. We expect that to continue, all underwritten by contracts. On the other hand, solar is a bit in limbo. Demand was relatively low. This is largely because we're focused on shipping into the US. And the US is restructuring the way that trade in solar is happening. The trade policy are shifting. One important resolution is expected by the end of March, but it may slip into a later point in time. We just have to wait. And whatever the outcome, that may trigger additional strategic actions. We have to watch the space. But the strong case is clearly here for semi. So we expect sales to be up by a low single digit this year with EBITDA at the prior year level. This is critical because last year we got about 160 million euros in CO2 compensation. CO2 compensation was put in place for companies for scope 2 CO2 emissions as we buy electricity from the grid, which our international competitors don't have to pay, just to put us on an equal competitive footing. It is calculated in a very funny way. You look at the volumes, the power that you bought in the prior year, and the prices for CO2 from 2 years ago. If it's a stable business, this is a wash. But it wasn't a stable business, but the CO2 price go into the roof a couple of years ago. So this goes down this year from 160 to just 70 million euros. So despite a hit of close to 90 million euros, the polysilicon business is expected to maintain its level of profitability. I think that is a very strong message for the veracity and the capability of the semi business, but also for the work that our colleagues are doing there. So you see this year, higher sales and efficiency offset higher energy costs. Obviously, the energy costs go up and the CO2 compensation goes away. So this is, I think, a very strong point. Again, this goes into others. Others is where we have all kinds of ancillary smaller businesses. Did you know that we sell road salt? We're the main supplier of road salt in southern Germany, Switzerland, and northern Italy. Well, there you go. So that's stuff like that is in there. But it's also, what also is in there is the membrane electrolysis at our main site. And the largest user of the membrane electrolysis is actually a PVC customer. And they've been in a cyclical downturn last year. So they didn't take as much volume as well as the capacity was there. So we underutilized that weight on the cost. And the residual cost is something that you see for the full year then. So what we are showing here is how the CO2 compensation works. We credit it pro rata into the segments, and then because it requires to be granted a budgetary decision by the government, we book an offset into others. This is why when we are asked about the quarterly results, we always guide to the sum of segments, not on the full thing, because everybody mixes this stuff up. But I think this is rather self-explanatory. We expect others, excluding the contribution from Siltronic, to be at -50 for the full year. And this is largely because of the above-mentioned infrastructure underutilization. So here's the development of our net debt. You see the strong cash flow from operating activities. We paid out our dividend. Again, we talked about our targets with regards to gearing. Here's our update for the first quarter. Expect sales at around 1.35 billion, with an EBITDA between 140 and 160 million. Again, this is pretty close to the consensus. But I think you see here in the segments that there is a lot happening, and that we achieve sales affected by lower FX headwinds, but also that the cost savings already kicking in and supporting the first quarter result, which I think is quite spectacular. Here's to the Q&A. In the appendix of the presentation, we split up what all the various charges were. You recall on the first page that we ended up the year with a net income or a net loss of -800 million. Quite a chunk of money. Now, where did that come from? Obviously, there's the organic EBITDA and the EBITDA minus depreciation, just below negative territory. But the PACE project, we booked a restructuring provision. That is going to be cash out. We also had to book an asset impairment in some Spanish fermentation assets, the Biosolutions. The business model there is changing, and it just turned out that some of the assumptions we made needed to be reviewed. So the Siltronic shares have constantly traded below the book value that we had in our books. So we were looking into this already, and if you looked into our regular reporting, you will find mention of this already in the first half-year results of 25. So at the end of the year, we had to close the gap. It's a book entry. But obviously, if you do restructuring in Germany, and I said that most of the employees that are in a go will come out of the German employee cohort. And if you reduce your evaluation on Siltronic, it doesn't look that great for your tax earnings. And if you have negative tax earnings, well, then your tax loss carry forwards aren't that worthwhile. So this is why the tax assets also had to go. I hope that helps. See that a lot of this are just book entries, and the cash thing is only one. Obviously, we're concerned. But I think we have the right tools, we have the right people, we have the right setup, and we know what we're doing. So through the year, we will have probably some more encouraging, better news. There is some exciting stuff in here. There's also some caution. What you're hearing from me today is confidence, absolute confidence, but with some muted optimism, considering what's going on in the world. Here's our contact details. I'd be happy to talk to you if you have more questions. At this time, thank you very much for listening to me, for bearing with me until here. Again, if we meet each other in a conference or so, please let me know. And thank you for your interest in Wacker Chemie. Have a good day.
Thank you, Joerg, for the transparent and comprehensive overview of Wacker Chemie's FY 2025 financial results and strategic outlook. Investors who would like to learn more about Wacker's restructuring measures, segment performance, and long-term recovery potential are invited to explore additional company presentations and financial result videos on Seat 11A.
Disclaimer. As described in the legal section on our website, seat11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. Seat11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.